I couldn't believe Clear Stock's numbers when I first looked at them. So let's jump right in. We see that the revenue is growing by 26% year over year, and the operating income actually doubled. Q2 was 43 million, and Q2 2026 is 83 million for a 94%, almost a straight up double on operating income. And then I look at the free cash flow, and we see a 65% growth in the free cash flow year over year. And that is just something you don't see every day. So as soon as I saw that, I just bought the stock. I mean, I didn't even have to look any further. But of course, I did look further. But I wanted to get a piece of this company as it was dipping. Operating margin is 19%, and it grew all the way to 30%. So we see these numbers just going up and to the right. And that is what we like to see. For free cash flow, we can talk about that real quick. Basically, Q3 2025, you see some big dips in their free cash flow. So Amex has platinum card holders, and they provide a credit for a free year of Clear membership. So what is Clear? Clear is an airport lane security skipping line membership. And so basically you just scan your finger, it verifies who you are, and you get to walk past all the TSA line, basically where they take your ID and they verify who you are. And this is just using your finger, and you get to walk past the whole line. And then if you also have TSA pre-check, then you can just put your items like your bag through the scanner, and you don't have to take off your shoes. You can just go straight through the scanner, and it takes like only a couple minutes. So that's what Q3 2025, that's why the free cash flow dipped. So after Q2, we see a big dip, and it was like $55, and it went all the way down to $44. We're going to dive into a discounted cash flow model at the end, but I want to keep going through the numbers with you guys. One other risk would be Amex concentration. So analysts suspect about 50% of revenue for Clear is from Amex platinum card holders. So, oh my gosh. Enterprise value, something that jumped out at me is the enterprise value. We see that they have $1 billion of cash, just like lying there. They have no debt, just $1 billion of cash. So they have good liquidity, no risk of defaulting. Besides that free cash flow, they have to pay back Amex at Q3. So we expect Q3 to be negative for free cash flow. Anyways, let's dive more into the numbers here. This is just a cool graph that we can see revenue, gross profit, operating income, and net income. We see that the yellow net income is going up. There we go. This graph is more interesting to me because we see that the CapEx number is actually pretty small compared to the other numbers. So it doesn't cost a lot of money to run this business. Once you have the airport security scanners already at the airports, then every member that signs up, it's just more annual revenue, and you don't have to spend money to keep this business going. You just have to maybe pay like employees, which will come from the operating income. It's not like a bunch of equipment that you have to spend this money on. It's more of like technology, like you have to keep everyone's fingerprints and everything like that. So there is some cybersecurity risk of people or hackers trying to get this information to steal people's identities. That's one risk for this company, is if they ever have a cybersecurity breach. But we see the numbers are just phenomenal. 465 million in free cash flow trailing 12 months here. So now let's look at the balance sheet. We see operating income going up and to the right, and net debt is going down, of course, because of the $1 billion of cash, and they have no debt. So, and then you see tangible book value is 141 million. Usually for software as a service, basically these annual memberships, so how annual memberships work is pretty interesting. You don't get the revenue until the service is completely paid for. So that is deferred revenue. Deferred revenue is So once you complete the whole service, once the member gets a full year of service, then you can show that as your revenue. So that's one thing we have to look at every single earnings report is something called total bookings. So whenever they book a new member, they'll put that as a number on their 10Q. It'll be total bookings. So I think if we just check real quick, total bookings for Q2 clear. So we can see that 33% year over year growth on total bookings, up 30% year over year. So basically that shows that the revenue, if we can expect for the next year that the revenue is probably going to be pretty high, like between 25%, 30% revenue growth because of the total bookings. And let's remember these margins for when we do our discounted cash flow model. We see 25% operating margin. Since 2022, they were profitable. So 5%, 22%, 12%, 15%. So that's like net income that can go down if they like do a lot of capex and like depreciation. They have to depreciate something or some kind of like taxes. They have to pay some taxes for being profitable, possibly. But the operating one is the main thing we want to pay attention to. It's just going up every single year. And then as operating income goes up, free cash flow is just following. And we see that 25% operating margin and then 46% free cash flow margin. Those are really big. Those are really good margins. Yeah, so this is like a historical financial table. So we can see this is the multiple on the right. We see right here that 20 trailing 12 months multiple. And then this is the free cash flow multiple that we were following just now. And the operating margin, 25%. And then also you can see the Q2 margin. So it's obviously going to be higher because in the trailing 12 months, we have to account for that negative Q3 margin for free cash flow, that big dip in Q3. So for my bear case for this stock, I did 5% revenue growth compared to the 20% revenue growth. And basically, we'll do this for 5 years. This is a 5-year discounted cash flow model. So every year I put that we grow revenues by 5%. And then operating margin is operating income divided by revenue. And it reflects the core profitability from core operations. So 15% operating margin, that's roughly a 10% decline. And in this bear case scenario, I'm assuming that they lose Amex as a credit card partner and they can't find anybody else. So remember, half of their revenue is from Amex. And let's say they lose them as a partner, then, maybe they'll go to Chase Sapphire Reserve members and then offer that. They have other options if they did lose their partnership. However, it's a synergistic relationship, meaning both parties benefit from this. Platinum cardholders are happy with skipping lines and feeling that VIP experience. So I suspect that they're just going to keep on being partners, and they've been partnered with each other since 2019. So let's continue on with this discounted cash flow model. I'm assuming that the multiple compresses from 20 all the way down to 10, which is very conservative in my opinion for a 5% revenue growth rate. That's very conservative. For base case, I just put 10% revenue growth, 25% operating margin, keeping the operating margin the same, and 46% keeping the free cash flow margin the same. And the multiple, I compressed it from 20 to 15 since it's not growing as fast. It's going to 10%. For the bull case, I kept the multiple the exact same, 2020. I assumed some more operating leverage, 30% boosted from 25% operating margin. And then free cash flow obviously follows. We see that there's a 21% difference in operating margin and free cash flow trailing 12 months. So I just added 2 extra percent to the free cash flow, since as your operating margin goes up, the more free cash flow it'll bring, because remember the expenses stay the same. And then the revenue growth, I put 15%, so a slight slowdown in revenue growth. And that would bring $108 fair value. And fair value is basically what it's worth today, assuming this scenario plays out. And that would be a 5-bagger. At the bottom here, we can actually take a look and see what the implied 5-year price would be, which would be $200. So if that bull case scenario plays out, you'll have a $200 share price after 5 years. And we can see that the share price right now is $44. I was covering it, so $200 5-year share price. This is just a cool graph because you can see at different prices, you can see what the IRRs are going to be. So it's very helpful for seeing what your price target is based on your hurdle rate for what you want your return to be. I always look for above a 20% IRR for my investments. And we can see that the blended IRR, if we move myself over here, we can see that the IRR is 21%. Assuming we merge all of these bear, base, and bull cases together, we get a 21% IRR, which is an implied share price of $117. And I don't think they're going to lose their partnership. I don't think they're going to lose their partnership with Amex. So I would even put the base case at 50% and change the bull case and the bear case to 25%. Let's actually keep the bull case at 33%. And we can put 17 for the bear case. That would give us a final share price of $128. So, and then we see this $73 blended fair value today. That would give us a 66% upside at this current moment. And we see at the top here, you can also see the fair value. It's that purple line. So that's a pretty big gap. Another thing we didn't talk about for Clear is their opportunity to go international. This could also keep their revenue growth rate keep going up. And also, they're only in about 60 domestic airports for the United States. And I feel like if this scenario happens, and also they want to be in sports stadiums, so those long lines at the stadiums, those really suck to wait in. If they offer that as well, that would be pretty cool. But we could say 25% revenue growth rate. Let's say they go international. Maybe 20%. Let's say they can maintain this 20% growth rate in revenue, and we can give them a 22x multiple, and it would be a 6-bagger if the bull case scenario plays out. And you guys might wonder how I found this stock, so I'm gonna go ahead and show you how I found this stock. It's actually on my trending stocks screener here. So over 24 hours, this tracks the most mentioned stocks on Reddit and Wall Street Bets. So I found it really far down the list. At the time, it was like probably 13th, but now it's dropped to 31. So it was around earnings time. So that's probably why it was mentioned a lot. But basically, the reason why I like this is it shows the green boxes. These KPIs are value investor metrics, and it helps show me which stocks are growing fast, which stocks are cheap, and which stocks have a high revenue growth rate. And if you guys want to learn more about my investing process, and if you want to try to become a better investor, I would recommend you guys subscribing to my website. And it makes investing a lot easier, and it makes finding stocks a lot easier, and it makes tracking stocks easier. If you want to ask me any questions, you can get a free Discord membership if you join the website, or you can just sign up for $3 a month and you can have direct access to me and ask me any questions you want. So if you enjoyed this video, check out the tier list. I just made a video going over my watch list tier list, and this is what it looks like. It looks pretty cool, right? You guys also get access to this if you want. So check out that video. Leave a like on the video too. Comment down below what you guys think about stock, and let me know what video I should make next, and I might just cover it.